Scott Gibson of Kitco Gibson Gold Fund was in Toronto last week at the world's largest mining show, the PDAC. Scott met up with Jay Taylor of miningstocks.com to discuss his view on gold, silver, and junior mining stocks. Enjoy.
Hi, my name's Scott Gibson with Beneath the Surface. I'm here with Jay Taylor of Hard Money Advisories. Hi Jay, welcome.
Nice to be with you, Scott.
Now Jay, gold price has had a nice run. It's been really moving the last couple of years. It's been great. Silver especially in the last 6 months. And all of the sort of junior mining companies and the mid-tiers have also had a nice run in terms of share price appreciation over the last little while. What I'd like to know, and the audience I think would like to know, is what's your take on sort of what's coming forward?
Well, if we were looking at the nominal price of gold and the nominal price of silver, that's one thing. I think that we'll continue to see the nominal price of almost all materials rise as long as the system continues to inflate. You know, post Lehman Brothers, we've had huge amounts of money pumped into the system, bailouts and all of that. It is finding its way, I think, into speculative behavior to a great extent. I don't think it is really from sound, solid economic growth as much as it is a lot of speculation, both around the world, actually, and it's driving energy prices up, it's driving copper material prices and precious metals prices, most of all, silver. And silver will tend to outperform gold and do better, even better than gold, when the system is expanding. Now, if we have another Lehman Brothers type of credit contraction, I think that what we'll find is that gold outperforms silver as it has in almost every major credit contraction.
And you've commented in your publication a number of times about inflation versus deflation and the effects that might have on the market. Can you share that with us?
Yes, indeed. Well, so if we're going into a deflation, I equate that with a credit contraction, then the real price of gold tends to rise. Gold may not even go up in nominal terms, but in terms of what it will buy, how much copper it will buy, how much oil it will buy, how much of everything else it will buy, how many stock, how much of the Dow Jones it will buy, gold usually rises in this environment. And that's very important because if the gold price is rising more than the other items, then chances are the profit margins for the miners will be better. Conversely, if we go into an inflationary environment, which we're in now, when the credit system is expanding and people are taking speculative trades, then silver tends to outperform gold, and that's why really silver's been on a tear. Since Lehman Brothers, silver has been far stronger than gold. It's just dramatically better. Now, where we go from here is anybody's guess, and it's one of my biggest concerns, Scott. I want to know which way is this thing going to tilt. Are we going to go into a deflationary, a credit contraction? I think we will. It's a matter of time. And it's really interesting, you know, I measure gold relative to the Rogers Raw Material Fund, which is a broad basket of soft commodities, hard commodities, clothing items, food, all kinds of things, metals, precious metals too. Before Lehman Brothers, an ounce of gold would have purchased only 15% of the Rogers Raw Materials Fund. By March of 2009, an ounce of gold would have bought 44% of the Rogers Raw Materials Fund. It tailed back to about 35%, and then with the Greek crisis rose to 42%. And now we're about 30, 35, 32% or something like that now. But the point is, from 15% to 32, from 44% to 32%, gold mining profits the margins are expanding. Gold mining major companies are having major profits now. They're starting to, their profits are growing very dramatically. Those guys now are looking for the smaller companies that are good at finding the gold in the ground. And the same thing is happening with silver. The real price of silver has risen dramatically. Silver profits, silver mining companies are doing extremely well. And I think it's the greatest, I say in my talks that we are in the bull market of a lifetime for gold mining shares. I think the same applies to silver. Though again, if we go into a deflationary, a credit contraction, I'm less bullish on silver and more on gold.
And what about base metals versus bulk metals and sort of commodities like copper or iron ore? What is your take on the inflation, deflation factors that it might have on those commodity prices?
So you know, the best scenario for the base metals would be a growing economy, a growing global economy. And Scott, I don't see that yet. Yes, there's a lot of demand in China, but is that sustainable? Is it market-driven demand, or is it some politicians making some deals with their buddies who are owning those companies, which is the case so often in China? So you have the potential, I believe, for malinvestment on a massive scale in China. That's what scares me. So that's why I think a lot of the demand that's coming out of China may not be sustainable. I know there's an argument about that, but that's my biggest concern. If we have a growing economy globally, then that's the best case for copper, for energy, for all of those. Right now, I think a great deal of the rise in the commodities and the energy prices is speculative. And I say that because we're not seeing robust economic growth globally that would drive that. Anecdotally, also, friends, people like Chen Lin, who I work with, Chen has lots of contacts in China. He says, you know, Jay, the companies aren't making much money. So what they're doing is taking their profits that they made in the past and they're going out and buying copper, they're going out and speculating, they're buying something that they think will go up in value. So there's a lot of speculation built into this market. If we have growing demand, if we see the global economy growing in a very solid manner, then I'll become long-term bullish on the metals. But otherwise, I'm a little hesitant and a little skeptical about the bull market. For hoarding, yes, I think people are trading in their dollars. They don't want dollars anymore. There's too many of them flying around, and they want something tangible. So I think that's driving the commodities prices. But again, that's inflation. That's an inflated system, and people, the currency is being cheapened, and so people want to trade their currency in for something that's real.
Well, and that's Jay Taylor here with us on Beneath the Surface with an inflation versus deflation perspective, what might unfold going forward. My name's Scott Gibson, and thanks for being with us.
Stay tuned for more interviews with Scott Gibson of Kitco Gibson Gold Fund from the PDAC. Thank you for watching.